Hi everybody, we're continuing today with chapter 7. Just going to go over uh, liabilities and essentially the current liabilities that we're going to start with today. Accounts payable, short-term debt, and a couple other things. And we're going to go, and this piece will only be covered on the exam for just the accounts payable and short-term debt piece that we're going through just the first about 8 pages of the chapter, and just from to page 238 in the book, and I believe to slide 26 here in the PowerPoint for the exam. So basically, I think we touched on this a couple of times already during our T accounts, but essentially, for liabilities, what we're talking about is when you incur essentially a loan and you're going to pay it. Now, since we're doing accrual accounting, that could be made with anything, including just having a bill to pay, or having, in terms of the Campbell soup example they were talking about, or um, you could be incurring more cost than you're simply receiving money right now because of seasonality. So you might be producing things now, but you may be selling them further into the season. So you're going to need a little line of credit, and then it will even out and you could pay it back. So that's, the ultimate use of a liability. And of course, in the fashion industry, I'm sure there's a lot of borrowing going on, and think about, yeah, let's apply it to the industry. What could it be going on for in the fashion industry? Of course, seasonally, you might borrow an X amount of dollars in order to manufacture your inventory, and then when you sell it, you pay it back. You pay it back, a little bit of interest, but it could be a current working capital play where you're actually improving your liquidity. You're able to finance short-term production, and you borrow a certain amount, like in this journal entry. And the journal entry would be you get cash, and on the other side it would be a credit to liability. And this is basically increasing your cash and your liabilities, and you might put that cash to work. Now, the piece that we're going to talk about is how do we account for these debts. And if you think about it, of course, like I try to relate it to an example that we have, just not just so it's math. Think about your credit card. If you didn't pay your full bill, end of the month balance times the interest rate, that would be your monthly interest, and that's an interest expense. How do we book that? Debit interest expense, credit interest payable. And that's essentially how we go around, how we keep going, calculating the interest expense. Now they get into here a little more on the discount and the future value, the present value. To be honest with you, I've been working with bonds and working in the finance world, or even looking at mortgages. It's never this complicated. It's always just the principal amount times the interest rate times the time period. So I just want to clarify that this is always the method that we're going to use. Is just how much is outstanding times the rate times the time in years. That is what the interest will be. So if on 25,000 we're talking about 9% in 1 year, it's basically 2250 a year, or divide that by 12, 187.50 per month. And essentially this is how we account for short-term debt. Now, there could be a note payable, it could be a short-term debt payable, it could be a credit line of credit / credit card payable, and this is really how we're going to approach it. The other piece that we're going to go into is current maturities of long-term debt. And this other piece is basically, all that is saying is we could have a bond that's about to mature, and we're going to pay off that bond, and that whatever part of the larger bond that's current, payable in the next 12 months is what we're going to be paying right now. And this piece is about paying off debt. Now, in terms of discounts, we're basically talking about very simple. If you pay off in the next 30 days, you get a 2% discount. So this is something that gets recorded when you sell something, and if the discount work goes through, then you book it as a net. Outside of discount, it's gross. So it's just something that to think about and look at in terms of discounts, and something that we'll look into further as we develop the knowledge in our book. And the other piece is unearned revenue or deferred credits. I think we talked about this prior, where this is basically if you say you have prepaid rent, somebody prepaid rent to you as a landlord, it's unearned revenue, and until you earn it, which means time goes by, you keep it as a liability, and you get the cash, you keep it a liability, and then month by month you reduce the liability and you actually increase the revenue. So you would debit, for example, this is subscription revenue, or it could be you would debit the unearned revenue, whatever it is, and you credit either rent revenue, subscription revenue, software fee revenue, and then your revenue becomes real as time goes by. The other major revenue that liability that we talk about is payroll taxes, which is when you have your own business, something that comes up. And this is basically mostly what we're talking about is the deductions that people have in their payroll, FICA, Medicare. Um, think the FICA includes the Social Security, I believe. Then we have the federal income tax, state and local tax, and then other voluntary deductions like 401k or other retirement plans. And this is a short-term liability as well that could be recorded and paid once the funds are released to that authority.